In this lesson, we're going to be talking about the fundamentals of investing. And this lesson is probably going to be split up into two PowerPoints just because it's kind of long. So, what are investments? Investments are assets purchased with the goal of providing additional income from the asset itself, but with the risk of loss. So, in your financial plan, you should have savings and investing. All investments have risk. Because they have risk, there is a higher chance of a return, and a return is profit or income generated by saving and investing. Trade-off, the higher the returns, the higher the risk. And what that means is the higher the chance of loss. An investment risk is the possibility that an investment will fail to pay the expected return. Investments have the potential for higher returns than savings. So, investments are important to building your net worth. Savings tools are monetary assets. They're liquid. They can easily and quickly be converted into cash, whereas investment tools are investment assets and may not be easily converted to cash, or penalties are charged to access the funds early. So investments are less liquid than savings tools. Investments help accomplish long-term goals. So money invested is usually used to pay for long-term goals, such as buying a house, higher education, and retirement. And they say it's recommended that at least 10% of net income is dedicated to saving and investing each time income is received. So savings versus investing. You save for emergencies, they're more liquid, they're limited risk, they're lower returns, and they're for financial security. Investing are for long-term goals, they're less liquid, they have higher risk, higher returns, and they're really to help improve your net worth. So let's start with rate of return. And we're going to be talking more about this at the end in lesson 6.3. Total return on investment expressed as a percentage of the amount of money you saved. So total return divided by the amount of money invested is the rate of return. So here's an example with Mandy. Mandy saved $2,200 in a money market deposit account. After 1 year, she has a return of $110. So she made a profit of $110. So what is her rate of return? You take 110 divided by 2,200 and you get a 5% return. Inflation. Inflation is a general rise in the level of prices. Inflation risk is the danger that money won't be worth as much in the future as it is today. How does inflation relate to investing? We want to strive to have the rate of return on investments to be higher than the rate of inflation, just because then we will be able to cover the cost of those rising prices. So there are different types of investment tools that we're going to talk about, and these are your very basic ones: bonds, stock, real estate, speculative investments, mutual funds, and index funds. Starting off, a bond. A bond is a form of lending to a company or the government. The organization pays interest to the lender, the purchaser, until the maturity date is reached. Investment risk, it's the least amount typically, and it depends on the type of the bond. Usually it has a fixed interest rate. Maturity date is a specified time in the future when the principal amount of the bond is repaid. Stock. Stock is a share of ownership in a company. A shareholder or a stockholder is the owner of the stock. Usually the stockholder owns a very small part of the company. Stock returns. You can get dividends from your stock besides the amount of money when you sell the stock. Dividends are a share of profits distributed in cash to stockholders. Stockholders may or may not receive dividends. Stock returns and capital gains. So the market price is the current price a buyer is willing to pay. If stock sells for a higher price than what is paid, there is going to be a capital gain, which is unearned income received from the sale of an asset above its purchase price. If the stock sells for a lower price than paid, then the stockholder will lose money. Next type of investment is real estate. This is ownership of residential or commercial property or land. There are potentials for returns. Capital gains would be selling the property for more than what you paid for it. And rent is another capital gain, is charging others to use the property. Real estate can be time consuming, but the potentials for returns are high. Speculative investments. These are very high risk investments. They have the potential for significant fluctuations in the return over a short period of time. Futures, options, collectibles. The type of return depends on the investment. So the futures, the options, and collectibles are all examples of these speculative investments, and speculative is risky. Mutual funds. This is when a company combines the funds of many different investors and then invests the money in a diversified portfolio of stocks and bonds. What is included in this portfolio? Bonds, stocks, real estate, and speculative investments. Types of returns include interest, dividends, rents, and capital gains. So the advantages of mutual funds: it reduces investment risk, it saves investment time. Disadvantage: fees may be high. Index fund. Index fund is a type of mutual fund designed to reduce fees by investing in stocks and bonds that make up the index. Index is a group of similar stocks and bonds. An example would be the Standard & Poor 500, and we will be talking about that in the next lesson. Lending versus owning. When investing, consumers can lend money or they can own the asset. Lending would be bonds, and then returns you get from interest. And owning would be like stock, real estate, speculative investments, and returns come from dividends, rents, and capital gains. Lending, this is just your general risk level. So lending, when you lend, your interest is lower, but your inflation risk is lower as well. So bonds, mutual funds, index funds would fall under lending. Dividends, rents, and capital gains. These are like your stocks, mutual fund, index fund, real estate, mutual fund, stock, mutual fund, index fund. They have increased potential for high returns, but they also have increased investment risk. So characteristics of investment tools. We're not going to do this particular activity here, but you can see at the very top, the highest risk, but the highest potential for return is speculative. And then it goes stock and real estate, mutual funds and index funds, and then bonds. Bonds are the least riskiest, but they also have the lowest potential for return. Investment philosophy. Everyone has a tolerance level for the amount of risk they are willing to take on, generally divided into 3 categories: conservative, moderate, and aggressive. Time may influence your investment and philosophy. If someone is an aggressive investor, they might be looking at more speculative investments, whereas someone who is a very conservative investor might look at your bonds. Portfolio diversification means you're reducing your risk by spreading out your money in a wide variety of investments. The goal is to create a collection of investments that will provide an